Hi guys, welcome back again for the second part of the FAPS Practice Assessment 1 from AAT website, and we'll be carrying on with what we are doing now. And I also took this time to investigate why I lost that 1 mark there, and I'll come back there and explain to you what it is. Okay, I didn't read the question very carefully, and then I realized what I have made that mistake. So let me go there and let's share the screen. I'm going to start this assessment again. So I'm going to do now, I'm going to jump to question 3 quickly, which is here. And then in this one, the question here, it says there, produce the bank reconciliation statement, use the minus signs to show any overdraft figures as negative figures. So only here I use the minus. Here, when I say add and less, this should have left for this £85, and I should have left it as a positive figure. And that is what the critical part here. We have to be very careful reading these questions, because they may say negative figure somewhere here, but it doesn't mean you put all the ones you're going to take away as a negative figure, because it says here add and you take away less. So basically it means if it's less, it's a minus figure, it becomes a plus as well, isn't it? So that what is going to give you a wrong answer. So I lost a mark there when I put that wrong information here, but my final answer was correct, because obviously I took that away anyway, and I got that £134.24, something like that way. So that had given me every answer apart from this one. For this box, I missed out on one answer. So you got 1, 2, 3 marks, but fourth mark was completely gone. But again, only a mark there. So unless you want to be getting every perfect 120 marks out of this, it'll be absolutely fine. And then also remember, guys, at the start of it, you have noticed on the assessment information, if you go here, let's see if I can go into that one. No, it's not letting me to go there. Or references. So if I click on references, assessment information, it shows here, it got 6 stars, and all of that together is 120 marks. So basically you need to get 84 marks out of this 120 to pass this assessment. Okay, so 84 marks. And let me see whether I can get the right answer. 84 divided by 1.120. Yeah, that is 70 there. So 84 marks is what you need to target for out of this 120 marks to successfully pass this assessment. But I have done 1, 2, and 3 on my the first assessment part 1 earlier, so I'm not going to be looking at them now. I'll be looking into task 4 onwards, and we will go from here now, task number 4, which is for 24 marks there. So bear with us, please. So now this task is all about financial statements for your sole traders and partnerships. So now we have shifted from the advanced bookkeeping side. From there, now we're going to final accounts bit of it. Normally in your books, it will be the last few chapters anyway, but this still carries a huge amount of presence for the overall qualification. So here, identify whether each transaction would lead to an increase in the owner's capital. So what happens if owner takes money out of the business? Is that increase the capital or not increase the capital? It will definitely not increase the capital. It will in fact reduce the capital. So the answer is going to be not increase the capital here, because that is the only other option you have, because it either increases or not increasing it, or we say no increase at all. So it's fine. A loss for the period also, it will not increase the capital, because if you make a loss, your capital will start losing the value, because you have to subsidize for that loss from the capital you invested. If you make a profit and you didn't take all the profit out, that profit, whatever left in there, will increase your capital. So let's see here, an injection of capital by the owner, of course, will increase the capital. And the owner putting his laptop into the business, that means that laptop now, it becomes an asset, and the capital account will get a credit entry there. Therefore, the value of the laptop will be assigned to your capital account as well, because you didn't buy that via the business, the owner gave you that instead. You're buying it outside, so it will obviously class as a capital injection. So now let's look at the next one. Identify whether the following statements about statement of financial positions for the partnerships are either true or false. So again, guys, it's a 50-50 question, but still a really good 2-mark question. So think before you choose an answer there. Don't just go, yeah, I'm not sure I'll go for this. Always look for key phrases, words, indicators. Like if you see a word called only, always, must be, those kind of things always says, always, the word always also. It will be giving you no other choice but that option only. So that means it's very rare you will get that statement as true. It may be some exemptions there. Therefore, it will not be always that. So most of the time, that statement with those words containing like only, always, must be, those kind of things there, it will be a false statement, but just in case, we'll check it anyway. A credit balance on a partner's current account means that the partner has drawn out more than he or his or her share of the profit. I don't think that is correct. Why? Because you're normally looking at the capital account and the current account. Normally they will have credit balances because that is what the money we as a business owe our owner. So if in their case, if it's a credit balance, means we still owe money to them because they are for the business a liability, a long-term liability. We have to pay them. So if it's a credit balance, means they haven't taken enough out, so the drawings are not exceeding their profit share. But if they say if it's a debit balance, it's understandable. Yes, of course, if they've taken more money out, that will be true. But in this scenario, it's false. Next one here, the finance by section of a partnership statement of financial positions includes both the balance of capital account and the current accounts. That's absolutely right. Because if you normally see that in the bottom part of it, it says here financed by capital and by current account, add them all together, you'll have that total amount. You compare that with your net assets. So here, next question is Imran and Nancy run in hotels as a partnership. Their trial balance 31st of March 2018 as shown as below. So what we have here, they have a huge trial balance there. All you need to do with that additional information and these interest calculations there to do the profit and loss statement. And then of course, you have to do a partnership profit appropriation for them. Okay, so you have to do an appropriation account later. So let's start with the initial one. We need to find out what is the information you're looking for. So you'll be able to identify what is this and what are these, and then we'll be able to populate the number. So by looking at the sales revenue, I know for a fact there are some information here. So let's get the good old highlighter out. So I'm going to say, what are the things I need to fill out the cost of sales side of it? So we need to have opening inventory somewhere here. Where is that here? Yeah, that is opening inventory now. Opening inventory. We should have some purchases. Yeah, purchases are here as well. We got that one. And then good old closing inventory, which is goes on the credit side here, because this one will go on the cost of sales side of it. Okay, so we will have those information now. So what we'll do, we'll take the highlighter away and then we'll start saying what are these for. So we're going to say opening inventory, purchases, closing inventory, and then we have to add anything supposed to be adding to that profit and loss statement. So let's see the credit side. If you see any income there apart from the sales revenue, because sales revenue is already been put down here, so there should be any other income. So by the look of it, there is one income here, discount received. So here I'm going to highlight this quickly. Discount received goes in this box. So I'm going to get rid of that one and then say here discount received as my income. What else I have less? These are the other expenses. What we should know, the expenses are calculated as $570. Let's put that amount here, 570 already, so we don't have to go back there and do it again. So what other expenses I can see here? So let's the calculator, so the highlighter out. We know the depreciation charge is an expense, one. You have irrecoverable debt is also an expense, and then other expenses. This all will go into the expenses box. So let's do the opening inventory first. So let's get the highlight out of the way. Opening inventory is. So double click on that box, keep that box ready. Just scroll up and find the number. The number is 9290. There's a quick idea for you, because for the video I'm just zoomed it as much as I can there. But if you want a little bit less, you can just zoom out, and then you'll see a little bit more boxes. Like here I can see smaller and smaller. That means I can see most of the boxes very clearly. So here purchases I don't have to worry about. What is that again? Remembering the number, I just start to copy and paste here. So here the number is 213 290. So we got that one. And the cost of sales, closing inventories, a little bit higher there, 7710. So I have put that here, but read carefully what it says. Okay. So the complete the following statement of profit and loss. Let me just make it a little bit bigger for you, so you don't have to worry about that bit again. I'll get there a bit later on. All numbers should be shown to the nearest pound. Any profit figure should be shown positive. Any losses should be shown negative or minus sign as negative. All the others should be positive. So here, even though the closing inventory comes off, um, the cost of sales calculation, it doesn't mean we had to put a negative figure here. We will leave that as a positive figure, and the amount will be the difference between the opening inventory 90 plus 213,290 minus 7710. I'm getting 214,870. And then my gross profit is going to be, it's minus the sales revenue 1653080. So that is going to be one. Oh, I don't need that one. I must have pressed the F1 button. Where are we? Okay, we're back in there again. My apologies, guys. I just went a bit haywire in there. Okay, so we got that information now. So we have the gross profit of 1,438,210 now. We have included that figure here. And then obviously any expenses we have to take it away. Depreciation charge, irrecoverable debt, and the other expenses. So we don't forget any of it. Depreciation charge is coming to an amount of 92,590. 92,590. See, that's auto calculated here, so that's not a big problem. Other expenses are 1,267,597 pounds. 597 there. Okay, and the depreciation, irrecoverable debts, coming to a total of 1,390. So 1,390. So that gives me, this is my other total expenses. So let's find out what is my profit for the period, or for the year. 76633. Now hold on. I also have to add this 530 on because it gets added on, isn't it? So do not forget about that one. 570 gets added on. So yeah, 77203. So I'm going to say 77203 pounds. So this is the profit I'm going to use on the next calculation to appropriate between partners. So here, let's put that profit to share here. And then obviously we will add and take away certain elements, and that allows you to find a residual profit available for distribution, and then we share it among your two partners. But then again, the additional information now, the profit sharing ratio between Imran and Nancy is 60-40. That means 6-4, even you can simplify that 3-2. That means if Imran takes out of maybe 100 pounds, Nancy take 40, Imran takes 60 pounds. And then if it's a 5 pounds, Imran takes 3, Nancy will take 2. That is a simplified format of it. So if I can split that as a share of 5, I will say 3 to Imran and 2 to Nancy. That is the simplified way of finding the ratios. And also, you remember, Imran's works within the business as and it is is entitled to a salary of £25,000 as well. So then see one more here, interest on capital and interest on drawings. So what happens, what we add to and what we take away? Anything to regarding something charged by the business towards the partners gets added on here. So for example, interest on drawings get added on here, but not the drawing itself. The drawing will be taken away on the current account, but on the partnership appropriation, the drawings doesn't get involved at all, because that is not how we used to supplement, or what we call the partition your profit among the partners available now. So the appropriation of uh, the profit account, interest on drawings get added on, and interest on capital, interest charge on capital, and then salary, these will be taken away here. So Imran takes £25,000 salary, it gets taken away. And then also interest on capital for both partners is coming out as £10,525 for each one of them. Okay, so 10,525. So with get added on here on both, and then also taken away from the both, and the interest charged on them on their drawings 41 and 141 and 41 pounds. So it is £182. It's been removed from there. So what we got left now, according to this here, all other figures should be positive. Enter zero, enter zero. Okay, so if there's figure is zero, enter a zero here. That's fine, absolutely okay. Nearest pounds, all preferred for figures. And any losses are okay. So here, there's no necessary you had to show minus number for these. This is added on, this is taken away. So we simply can say 77,203 plus 182 equal to this, minus 21,050 minus 25,000. That gives me 31,335. And the profit now shared among these two partners, divide by 5, multiply by 2, 18801 for Imran. Nancy will get 12,534. If you add those two together, you'll get 31,335 pounds as your profit for distribution. So we will have these two matching there, and that should give you the full 8 marks. And for some reason, for the last assessment, I got a incorrect mark for something. I'm not sure what is that for, but it could be this closing inventory. That's what I'm thinking, because they didn't say anything about it. They also said any profit figure should be shown positive. All should be, positive figures. So yeah, I don't think they should taken that away from me. But again, it could be on might be wrong there. Something is gone, not 100% right. I can check with the answers later on. I probably might put a comment in there. Let's answer this. Let's move on to the next question. Task 5 is 18 marker. This task's about accounting principles, qualities of useful financial information, and interpreting financial statements for profitability ratio. So here, a little bit theory involved in there, but let's have a look into that one. So this first scenario they're talking about, they want to know the principle described in here. Value of goods sold but not yet paid for the year and is included in the sales for the year. That's a classic example of accrual accounting, because you are recording the transaction when they incurred, not when they are paid. Okay, so you have to record a credit sales when you actually sold them. When you get paid, it does not matter. You don't say, oh yeah, only when I got paid, I'm going to record that in my books. No, you do that when you actually doing the transaction to begin with. And then obviously when you get paid, you're simply settling a debt there. So here, this is what we call an accrual principle. Rena owns a greeting card business. When she takes a card for her own use, she recorded this as a drawing. Of course, that is the right principle, because a business entity, or the dual effect principle here, it concerns your business is different to the owner, because legally They are both different for accounting purposes. We consider that way as well. Okay. Sometimes for some other legal procedures, like the owner is responsible for all the bets, the business's debt because they have unlimited liability as a sole trader. But for the purpose of accounting, we will classify that person as a separate person to the business. So that is the business entity principle. Stationary items such as staplers are treated as an expenses rather than non-current assets. That is for the materiality, because it is not material to the business to capitalize a small, like asset like this staplers, printer cartridges, the one-use pen and paper. We'll just put them as an expense to the business. Even though we carry them over using them for a while, it is not viable for you to record that in your non-current asset register to depreciate them, anything like that way. So we will class them as a one-off expense, but we may use it for a while until we get rid of it. Okay, so here it is the materiality concept. And then the last one is non-current assets are depreciated. Now here, the fourth one we got here, accrual principle and going concern principle, they are both applied here. The reason why we have to accrue the expense we have in every year in way of depreciating your non-current assets. Why is that? Because your asset doesn't lose the value at the last year of the useful life, or the year we're going to dispose of it. It gradually loses it. That is the point, because the time itself it's used, it has to be going as every year you loses some of the value. So that is one of the accrual. But then also the going concern means we are expecting that asset to be used for a foreseeable future until we scrap it. Therefore, we expect the business to continue trading. That is your going concern principle. So it is a clear example of those two principles applied in here. Now we're looking at enhancing qualitative characteristics being described here. So the first one is when knowledgeable and independent observers can reach a consensus that the information is faithfully represented. So if I look at it here, it is more of a verifiability. The reason why the people who's outside can verify this information clearly with information, because we are looking at it as being faithfully represented to them. Okay, so that means something to be verified. And then when the information is clearly and concisely classified and characteristics and presented, it does not mean the complex information should be excluded. It's there, but we don't have to use all of it. It's mostly due to understandability of it. Okay, so the understandability of something given to you, if you look at the financial statement, can you understand by looking at the main statement what is the summary of it? That is the part they're trying to say here. The complex information, they have split it down into annexes, addendums. That's something for you to investigate further. But for you, it can be clearly and concisely classified, characterized, and presented. That is more of a thing with the enhancing quality of understandability. Now, let's see these statements true or false. Then it's going to be a fun scenario we can discuss about this. There are four there. The first one is interpretation of entities' financial statement using ratios is only useful for potential users. The word only straight away suggests it can be only for potential investors. That's wrong, because it can be used for so many different reasons. So this is clearly a false statement. Now let's look at the next one. In order to provide useful information, ratios needs to be compared with different organization, different times, or industry standards. That's completely understandable, because you can't just keep the ratio and just do nothing with it, because you have to find a way you can see whether it can be comparable to something else, possibly the same type of organizations outside, different time period with your own organizations, or you're looking at a certain task set by the industry. So that standard, will that be allowed or not? Okay, so that is a really good example of it, because it says it needs to be. Yeah, that's fine. It is absolutely good. You use the ratio to those kind of scenarios. The disadvantages of ratios is that they are based on previous performance, which may not be valid for making predictions for the future. Yeah, it says there. If they say they will not be valid, that is wrong, because they use the word may. That gives you a potential other opportunities to scrutinize this information. So that is absolutely right, because sometimes the ratio can be all right for future predictions, but on a fluctuating scenario like currently what's happening in United Kingdom, the the economy is kind of in a dire straits because of mismanagement, put it that way, I don't know, or you can put it down to the overall climate of it. But apparently in our G7 countries, United Kingdom's performing very bad because there was some decisions made in the past, which I may say people do agree or do not agree, because we're not going to go into a political discourse here, but that gives a business not much way of predicting the future with the ratios they may obtain from the past 2 years, 3 years ago, 5 years ago, because they will not be applicable now. So that is true here. All other things being equal, if a gross profit percentage increases, your net profit percentage will decrease. That's not right, because if your gross profit increases and your expenses doesn't change, they're saying here and other things being equal, because it didn't change, your net profit percentage should increase as well along with your gross profit percentage. But in this scenario, if it decreases, something has changed, so this statement is not true. Okay, so that's fine. Now let's look at the next one. They're looking at it. You are given the following information about an organization, and they want you to find out potential ratios for these two examples. So they ask you to find the return on capital employed and the net profit margin. You may ask me, what is return on capital employed? So let's go into our trusted spreadsheet here. If I can find it, I still got it here. Yes, our spreadsheet here. I'm going to be using that to understand what it is. Your return on capital employed, ROCE, is equal to capital plus any non-current liabilities. Non-current liabilities such as a bank loan or a mortgage on a property or anything, something you thinking of paying for long term. A bank loan or a personal loan, you took it like from a friend or a partner. Partner can give you a loan. It doesn't have to just invest in the business. He can give you a loan, expect to pay within few years, couple of years, 3 years, or anything like that way. They also go as my capital employed, because what you doing by having that, because you investing the money and also took a loan, you expect that to return some profit for you. So ROCE is going to be this is the capital employed. So capital employed is equal to capital plus NCL. So ROCE, return on capital employed, is going to be equal to net profit, or profit for the year, profit for year, divide by capital employed. Okay, so here in this scenario, it is going to be your profit for the year 59,160. I'm going to divide this by a sum of 97,500, which is your NCL, plus 136,400. Okay, now I haven't changed that to a percentage, so it is on a decimal number now. So in Excel, that's a really good option here. You see that percentage button, click on it, and then change to percentage, and then increase the decimal to 2 decimals, and it'll give you 25.29. So here I'm going to say this one is equal to 25.29 as my return on capital employed. So that means the return suggests I will be able to recoup my investment in the business in the form of long-term liabilities and the capital by 4 years. Because if I returning every year 25%, for hypothetically speaking, I will make my money back within 4 years. Everything's come back. After that, it's just going to be purely profit for me. Okay, so this investment will be covered according to what they have said here. And then the net profit margin is fairly straightforward. Net profit margin is going to be thinking as your sales revenue is 100%. So it's going to be net profit divided by sales revenue. So I'm going to consider that calculation here again. 59,160 pounds divided by 423,700 pounds. And then I'm going to use that ratio again, the way I have done, and increase the decimals. I'm getting 13.96. Let's go back to spreadsheet. Yeah, that is the amount I'm getting there anyway. All right. So we have put that number down. Let's see what else, what extra numbers is giving me. Yeah, that's fine. Two decimals will be that amount. So we got that return on capital employed sorted as well, and the net profit margin. And then we got a couple of more true or false statements. They're saying here shop wages as a percentage of revenue has risen. That means your expense towards your business has increased. That should result in less profit, isn't it? Because if your expense percentage exceeded, then your revenue, your gross profit or the net profit margin will come down. So here the rise could have been caused by a business taking on a new person in order to stimulate growth. Yeah, it is understandable because for you, your revenue will be increasing for foreseeable future. But for now, the new expense, it is going to be incurred because we employ somebody new. So that is true. The rise could have been caused by revenue rising during the year due to increased advertising. No extra staff were employed in the shop. Makes no sense because your shop wages increase means it could be only because I have employed somebody. If they say there's no employed staff newly, so that means that is false. It is common sense. You just have to correlate this statement to this this sentence to this statement here, whether that is going to be applicable or not. Could be for some other reason, but not because of your the percentage is increasing. So let's see. Now we're down to task 6. So the task 6 now for 12 marks. It's not massive, but still it carries a good weight towards everything there. So let's see what we got here. So the first statement they're telling you about. Annual sales for the year is 102,320, and on average, it takes a customer 1 month to pay. So normally, how much is going to be per month transaction? So it's going to be 102,320 divided by 320 divided by 12, and I'm getting about 8,526 pounds and 67 pence. But this is the closest to that one. So that will be a balance of end of a month. Because if I consider that's the first month, by end of February, this is the amount should have been paid. Because in January end, we will be done that. By the next month, will be that should be paid. But the one from February will be carried over to the next month because it takes a month for them to pay. So if I'm going to look at it, if I want to look at the balance for your trade receivables, it should have amount closest to that at every month end. Okay, so it's not in the middle of the month, at the month end. So here, referring to your response to part A1, you've just printed an H receivables list from the accounting software, which is total to 55,750. So what could be the reason? What action you should take next? So you check the accounting software for errors, investigate whether there's been any reason for the unusual balance, report the figure that is produced by the accounting software, report the figure you have calculated as it looks more reasonable. I will say you go for the first one because obviously, because of a disparity between the amounts, it is almost more than half of your sales revenue. You don't think your customers is going to be haven't paying you for 6 months. You need to investigate it further and not report any of the figures you have calculated or you obtained from the report. All right. So this is the answer for that one. 1 mark. It's not much there. If the gross profit is calculated as a percentage of revenue, it is called a margin, isn't it? Because your percentage of revenue means revenue is your 100%, margin is going to be a gross profit in there. If it's going to be markup, it is been calculated as a percentage of your cost of sales. Cost of sales 100%, you mark up whatever is your as your profit, and then you add those two together to get the new sales value. Now in this scenario, the percentage is revenue, so it's definitely a margin. Now, we have one more question now. It's about missing information from the previous transactions. So this is more of an incomplete records. So normally you do your transactions top to bottom, isn't it? You put down day book figures, opening balance, and then bank figures, whatever is in there, you're done. And then you find balance carried down, and then you look at the new opening balance for the next. That is what you normally do. But when it comes to incomplete records, it doesn't have that same ring to it, because what we do, we're trying to find something backwards. You're doing a reverse forensic here, trying to find a missing figure with a given information. They normally give you opening and closing balance straight away. Sometimes they give you closing balance, they want you to find the opening balance. Like that way, you have to do it reversely. So here they're giving you day book summaries, they're giving you the balance of your receivables and payables, and they also give you bank summary there. So what we now have to do, we have to start looking at those information and then enter those in these books there to find the relevant missing data. I may use the spreadsheet, but at the moment I'm not bothered about it yet because I don't think I need it yet. But let's see what is the first question. The first part is using the information supplies, find the missing purchases return figure by preparing the ledgers control account, payable ledgers control account. So you got your PLCAs here. Remember, ledger control account, the amount goes there. It's always going to be the value including the VAT, because remember from your day book, total, VAT and net. So the ledger control always get the total figure, which is always inclusive of VAT. So remember that part, because you will use that information to draw your VAT control account, which has been given next year. And then they haven't said anything about decimals because I can't see a decimal mention here. So we put the figures as the whole amount, okay, the nearest pound. So the first part I know on the ledger control account, I need to look at the payables. Look at the payables, the starting with the balance of 10,281. And if you tell me if it's this is the credit side of it, and I'm going to put it down here. If somebody come and ask me why that is a credit side, you're on the wrong course, because you have to remember it's a liability account. Liability means it's a credit account because it's the money we owe to our suppliers. So please remember your account types. Okay, this is the liability account. It starts with that one, and the balance carried on figure, what we ended with, that's 15,482. That will be on the debit side, 482. We have that figure also embedded. Now we have to find the daybook entries. So from the daybook, look at that goods, VAT, and total. So they have confused you by giving the goods first. Normally, this is going to be a gross, VAT, and net. But they say goods here. So this is basically net. They got the total figures here. The total figure is 194, 160. So here, purchases, 194, 150. 160, sorry. Put the right amount here, 160. Do I have anything else I have to put in these boxes? Because if I look at it here, I have that, I have that, I have that. I haven't found that yet, but at the moment I have only that balance. Something is missing. What it is the amount we have paid our trade payables. From our bank account summary, it says there we paid them 187,129 on the credit side. So it goes onto my PLC on the debit side, 187,129 pounds. So we have done everything it is required here. Do I have anything else I need to consider? Nope, nothing else here, nothing else here. So the difference between those two will be my purchase returns gross amount, 204,441 minus 202,611. That gives me 1,830 pounds gross figure for your purchase return. This is very good. You calculated it now, because we need to find the VAT from that one, and we have to put it down in this purchase return. So the VAT for that one, you divide that by 6, which is 305, because remember, when there's a gross amount, there are 6 shares and your net is 5 and your VAT is only 1, because 20% VAT, 100% net, 120 gross. So if that is 120%, to find the 20%, you just have to divide by 120, multiply by 20, or simplify that to 1 in 6. So if you get a gross amount to find the VAT, the best way to do it, divide it by 6. Okay, that is the trick I've taught students. So many of them say that's the easiest way to do it. So here from the purchase day book, what we got now, purchase day book has a VAT figure of 32,360. 32,360 we have got there. If my purchases day book is here, my sales day book definitely going to be in this side. The sales day book also giving you value of 48,560. 48,560 is the VAT we charged our credit customers for their their sales revenue. So this is the VAT. And then also I have noticed there is the cash sales here. The cash sales, the amount we receive, it is also inclusive of VAT. So we're going to divide it by 6 to find the VAT on the cash sales, which is £5,100. So it's 5,100 I have done. Do I have anything else I need to report? If I'm going to look at it here, there is a payment of HMRC, the VAT we paid to them, whatever it's done from our bank account, which is 22,708 credit side. So here, 22,708 debit side. Now, do I have any more? I'm just making sure I didn't miss out on anything, because if I look at it here, this VAT is done, that is done. This has all been sorted before. The trade receivable payment, it not matters to me because we're not looking to find a missing information from your RLCA, and we only have to worry about any other information we need to get rid of. And also, let's see here. Any other things considering VAT? No, nothing else here. So whatever it's going to be left over is your VAT control accounts final balance carried down. So here 69,251 minus 55,068, it will be equal to 14,183 pounds as my new balance carried down for my VAT control account, because this is the balance of VAT we still owe HMRC after the year end. So we have done all the information here now. I'm pretty sure we filled everything in it's required. The figure is fine. That figure is also fine. And I think we have completed everything. So let's see quickly here. Yeah, it is now going back to question 1, which I'm not going to be much fussed about. So let's see here. Let's submit this assessment to see whether we have completed it as per what we are expecting to do, because I have done on the part 1 of the video the first 3 questions. So let's submit it. Waiting for the answer. Yeah, I'm still getting 23 out of 24 here. So there is something I might be missing out, 1 marker somewhere, but I'm pretty sure I will be checking that later on. I may put it on description somewhere why I missed that 1 mark. But then again, that's not bad. Out of 120, I got 118 because there was a 1 mistake I made here and a small mistake you made there as well. But I'm not sure what it is. I'll check it with the answers later on and to see whether it's comparable. Yeah, so now guys, as I said, this exam is for 2 hours, 30 minutes. So you have to plan your assessments in a manner it allows you have enough time to check back in there in case you require to do a like amendments to any of yours. And then also, if you look at it, 6 questions, I'll say normally allocate about 20 minutes each questions, 25 minutes for harder questions if you like. So that gives you a little bit more time with those and slightly less on the others. But whichever way you do, you allow yourself at least to 15 to 20 minutes check time to make sure everything's filled out, no boxes are left untouched. If there is anything on the boxes you haven't filled in, if it's multiple choice questions, please find a way you get an answer for that one. And then the ones you couldn't calculate, try your best, because obviously this exam itself is a huge exam. Anything you do, anything you don't do, it depends. If you put something in there, if it's wrong, absolutely fine. But if you don't put anything in there, that means you have no chance of getting any marks. So you have to try your best to fill every box possible. Do not leave anything untouched. Leave no stones unturned. So that's it, guys, and I hope you enjoyed it. I will be doing the next assessment, practice assessment 2 for your FAPS module in 2 weeks time. I will be recording during the Christmas week and I'll be uploading that as well, because some of my students who are sitting for the exam in January 2nd, 3rd week, they're not doing that mock assessment until later on. So it's too early. If I release it now, I'll probably send it a bit later on, so you'll be able to watch that as well just to come off your Christmas break. And I wish you guys all um, the best with your exams. And if I don't, publish another video beforehand, wish you happy seasonal greetings. And I'm looking forward to see you all guys again very soon. So yeah, wish you all the best, and you all take care, and good luck with your exams. Bye bye.